Hey there, everyone. Welcome back to another CDH Lunch and Learn. My name is Darren, the Community and Memberships Coordinator here at CDH. For those who are joining us for the first time, CDH exists to connect innovation with industry, and we do that through a variety of platforms such as running events, our community and clubhouse for founders, landing pad services, and corporate innovation. So today's Lunch and Learn is part of our community and clubhouse offering, where we support founders by giving them the knowledge that they need to scale. We're really excited to have Claire Thompson in today from HSF Kramer.
Correct.
Yes,
yeah.
she's a partner and the co-head of the venture team there. So she's got a lot of experience working with startups, helping them manage their raises, ESOPs, all manner of legal problems. So thank you so much for Claire for joining us and coming in today.
Thanks, Darren. It's good to be here.
Awesome. So today's workshop will be focused on how do you actually navigate a raise. So we'll just head into the slides, and Claire will get started talking us through and demystifying some of the legal jargon that can trip a lot of founders up when they go through their first raise.
Yeah, thanks, Darren. We dive into it. I guess to kick things off, the first thing that I would say is that there is heaps of jargon in the capital raising space. And you've got to know it, you've got to understand it, because it will totally trip you up. Sometimes I wonder why we have so much jargon. I blame the Americans. They're the ones who started practice in this area, and they're the ones that we have to thank for a lot of the phrases. But I think going in, it's really easy for a founder to feel overwhelmed, right? There's a lot of jargon. You're doing this maybe for the first time ever. And all the investors that you're talking to do this every day of the week. And so having the right team around you to support you through the journey is really important. So that could be fellow founders, people like CDH who have got a clubhouse offering. It's also your legal team that you engage, and potentially some accountants and tax advisors as well. So setting things up to make sure you feel supported at the start is really good. Now, we're good to go on slides?
Sorry, I don't use PowerPoint enough.
Oh.
Where are you going to present?
I think this is great. Try up the top.
What a hilarious. Surely. Yeah, right.
Let's do it. Okay.
Yeah, great, guys. Sorry about that.
Sorry, I think that was enough filler for me. Let's get into it. Cool. So the first time that you raise, you're starting with a $2 company. It'll probably be the founders who are the only shareholders right at the start. Maybe if you've bootstrapped for a while, you might have an employee equity plan, but that's about it. And so for your first raise, there's really 3 different structures that you need to know about. First is a SAFE, second is priced equity, and then the third is sort of debt, convertible notes, and other in there. The first time you raise, a SAFE is most likely what you will use. Stands for Simple Agreement for Future Equity. It's really common to see these for a pre-seed, pre-pre-seed, pre-pre-pre-seed, and even seed rounds. Most accelerators in this country will invest using a SAFE, and it's really nice because it's a very simple instrument. It doesn't require you to come to a landing on valuation, which is handy. It doesn't require you to have a long-form shareholders agreement in place with lots of rights and a big negotiation around that.
Right.
And so you can actually get the money in the door in a relatively straightforward way. It's about 4 or 5 pages long. There are a couple of open source options available on the internet. I would express a little word of caution about just diving in and using those, though. Well, the majority of a SAFE is very standard. The calculation of conversion is really complicated. So how does it work? Essentially what a SAFE is saying is, I'm going to give you $50,000 to go and build your business. I don't know what your business is worth today, and I don't know what it's going to be worth in the future, but I know that you will need to raise again. And so the reward that I get for taking that risk on you is that at the next round, my $50,000 will convert into the valuation that you agree with your lead investor then.
Right.
But it's subject to a discount.
Yeah,
So
okay.
market practice, we see discounts somewhere around the 20% mark, give or take, depending on the circumstance.
Yeah.
And that's the investor's reward for going in especially early.
Yeah.
And the whole thing really piggybacks on the next priced round. And I'll talk about that in a minute. But what it means is I'm going in as an investor and I will have investor level rights, but I'll get those rights when you get to that next stage. When you agree them with your lead investor for your next round, that's what I'll dive into. There's a couple of other things that you need to think about though, which is when we convert based on a fully diluted capitalisation, right? And so there's always a little bit of back and forth about what should be included when we calculate the fully diluted capitalisation. So that's obviously the shares that are on issue in a company.
Yeah.
It usually includes the employee equity. That can be the employee equity that has been issued and that is allocated, so your pool, your unallocated pool. And then there's a question about what do you do about other convertible instruments? So if you've gone out and issued other safes, or you might have other convertible notes, how do we account for those?
Right.
And that is where it can get really messy and where you need to model it out, how the conversion will work to make sure that you actually understand what you're signing up to.
Yeah, okay.
So that's my one note is that's a little bit complicated. But otherwise a safe is pretty straightforward.
So would you say that most early stage investment falls under a safe?
I would say yes.
Yeah, okay.
At the moment.
Yeah.
And you don't have to be afraid of them. You just have to know this one point.
Right.
Otherwise, it's pretty straightforward. Your safe holders are not shareholders. All they have is a right to be issued shares in the next round. And so you don't need a shareholder's deed. They will not have traditional shareholders' rights per se. However, your safe might allow them some rights like you agree to give them information about how the business is going.
Right.
And you might give them what we call pro rata rights, which I'll talk about later.
Okay.
But essentially a right to invest
Sure.
at the next round and keep following their money as you go.
Oh, yeah, okay.
Cool. So that's a safe. Priced equity is a fancy term for shares, really.
Yeah.
And that is definitely the garden variety that we see and that we talk about. Typically, I'd say definitely Series A and beyond, you're seeing priced rounds. Often the Series Seed more and more is becoming a bit of a marquee transaction for companies, and so that will usually be priced as well. And when I say it's priced, I mean that you, the founder, agree a valuation with the investor.
Right.
So we agree, you and I agree, that your company is worth $100 million today, right? And so you have a pre-money valuation and a post-money valuation. So I might be investing $20 million at a $100 million pre-money valuation. That means the post-money valuation is $120 million.
Oh, okay.
And what falls out of that is the number of shares on issue, and it falls down to a share price as well that you calc based on that.
Yeah.
Priced equity means that you're going to be issuing shares. So you will enter into what we call a shareholder's deed, and I'll talk a little bit more about that later. You will also have a subscription agreement where the investor chooses to invest and it governs the mechanics of that investment.
Okay.
And you'll have a constitution. From a practical point of view, your first priced round is potentially your most important because that is where you're going to set the status quo on your legal documents.
Yeah,
right?
yeah.
So that is where you're going to put in place your shareholders' deed. That's the document that contains all of the rights and obligations of shareholders, so founders, investors, and the company in there.
Yeah.
And so if you start out with a view that you might have your, say, board composition, for instance. Say there's 2 founders and 2 investors. You might say, okay, we're going to start out with just the founders on the board. Investors, you don't need to be on the board, and they're comfortable with that. Then that sets the status quo. The next round, maybe an investor will say, it's time.
Yeah.
You should have an investor on that board. Okay, we just build on what is existing. Next round, maybe add another investor.
Right. So how difficult is it to reverse these sort of early status quos?
Yeah, it's a really good point. It's hard.
Yeah, okay.
It's hard. So if you grant a lot of rights in your first shareholders deed,
right,
it's hard to walk back from that.
Yeah.
Generally,
okay.
what we see is that documentation will become, I don't like to say founder friendly or investor friendly, but generally, investors will expect that all of the existing rights that they have are maintained.
Right.
And then the new investors that come in each round will usually
Expect
ask
the
for
same thing.
Yes,
Yeah,
and they'll
yeah,
usually
yeah.
have maybe a little ask. On
Yeah,
top of that,
wow,
right?
wow, okay.
So they might say, okay, I see that you've been giving all of this information to your seed round. I want that, but I also want to sit on your board. And I
So
want
it's easy to
that.
get into like a slippery slope of just like
I want
people just
that, but
wanting
I also
more
want a super pro rata or something
Yeah,
like
wow,
that.
wow.
So it's not necessarily a slippery slope, but it doesn't go backwards.
Yeah,
And
okay.
so if you go into your first price round with a mentality of, okay, this is probably the high watermark in terms of founder control,
Yeah.
that mentality will help you set up the document in a way that is consistent with how you want to be running your company. Because ultimately, the idea is that you get the investment to go and run your company.
Yeah.
You don't need to become a slave to the legal documentation, and we don't want you to become that way.
Yeah.
So it's about hopefully setting things up right so that you can just go and run the business and you don't have to think about it again.
Yeah. Because that's when it starts to take away from the actual running of your business and the things that actually move the needle forward rather than getting bogged down by the mire of like all this legal stuff, right?
Totally.
Yeah.
The third bucket here that I would just touch on is debt and other instruments. So convertible notes is a structure that we do see a little bit. They're typically used for bridging rounds. So the nice thing about a convertible note is that you don't need to come to an agreement on valuation. So it's similar to a SAFE in that way. A convertible note is a debt instrument. So what I'm saying to you is I'm actually lending you $50,000.
Yeah.
And you need to pay that back to me in 2 years' time. But if in the meantime you do another equity round, I'll convert my $50,000 at that equity round.
Right.
If it goes 2 years, you haven't done a round, then you need to pay it back to me. Or maybe we agree that I convert at that point in time at an agreed valuation.
Yeah.
So it's structurally quite similar to a SAFE, but it does have some debt features, which is why we see them more commonly used these days for bridging and later rounds.
Right.
There was quite a trend of doing convertible notes around 2022, 2023, after a lot of high valuations were sort of set in 2021 and people didn't want to have a down round. I'm seeing them used a bit less these days, but they do still crop up where the circumstances make it appropriate.
Yeah, okay.
And then I've just put in here a few other options to consider because not every company needs to raise venture, and there's a lot of other options on the market now. So venture debt is a great product that we're seeing crop up more and more. I mean, R&D loans, I'm sure a lot of people are already very familiar with those. And if it's available to you in your sector, there's a lot of grants out there or matched funding arrangements that can be really good and less dilutive. So I just thought I'd throw those on there for completeness.
So was matched funding like if you raise X amount, we'll match you?
Yeah.
Ah, yep. Yeah, I heard a VC was recently, given that term.
Yeah, absolutely. And so typically that would be through sort of government programs where there's a specific area of industry that they want to incentivise.
Yeah.
If you qualify for it, it's great.
But does it make things a bit complicated to manage because because it's so much there's so much variance between like the total funding that you end up getting because it depends on how much initial funding you're getting and then it's going to be matched. So then like isn't it like there's an inaccurate picture of like how much you'll actually be able to raise in total?
Yes and no. I think it doesn't impact on your cap table because this would typically be non-dilutive.
Yeah.
But it would impact on your business plan. So you might say, okay, I want to raise $3 million and then there's an opportunity to get an extra $1 million in matched funding.
Right.
Because we want to deploy $4 million across these different initiatives in the business and we think it will give us 12 months of runway. If that match funding doesn't come through, your investors will want to know, okay, well, what's the plan if you only end up with $3 million?
Yeah.
And it might be, well, this program we really want to do, but that can actually wait.
Right.
And it will only give us 10 months of runway, and then we'll be raising again in 10 months' time.
Okay.
So that might not be the end of the world, and that might be fine.
Yeah, it's just about being prepared for different circumstances.
I think that's right.
Yeah. Okay.
Cool. Let's keep going. So if if there's one piece of advice that you hear today, it's this. The deal is done in the term sheet. And that might seem strange, coming from a lawyer, to tell you that the legally non-binding document is the most important, but actually, practically it is. And the reason is that this term sheet represents your handshake deal. So the way that it works is you'll go out and have lots of meetings with investors, you'll pitch, etc. And then at some stage, you'll be presented with a term sheet from your potential lead investor. You'll sign that term sheet and you'll sign it with your lead. You absolutely have to understand everything in it, and your term sheet is negotiable. So if there's a feature that you don't understand very well, if there's some jargon in there that you're not familiar with, go and get advice at this stage.
Yeah.
Because when you sign this piece of paper, although it is legally non-binding, your investor will go away and they will get their approvals based on it. And you, as the founder, will probably go and talk to others in the ecosystem, angels or other VCs, to fill out the round based on these terms. And so you'll go and get your other commitments based on these terms. So if there's something in there that you don't understand, it can be really hard to move away from it later.
Right.
Because people have committed based on these terms.
Yeah. Okay.
And so you want to try to stick as closely as you can to the term sheet when you move into what we call the long form legal documents. But yeah, that would be my number one tip. Yes, it is legally non-binding. You can change the deal later. If you completely stuff up and you read your term sheet and you go, oh no, what am I committed to? It can be changed. But you'll probably have to waste a lot of time, waste a bit of money, and potentially you chip away at some of that goodwill that you've developed with your investor as well. So yes, it's not the end of the world, but it's not a problem that you want to have if you can avoid it, just by reading the thing thoroughly and getting some advice at an early stage.
Yeah.
And look, I think it might be a bit... I think some founders might have a little bit of trepidation about reaching out to a lawyer just at this stage, because I think, oh my God, how much is this going to cost me?
Yeah, right.
Most lawyers will not charge very much for this. And like, I actually normally don't charge really clients to look at this, because actually it's going to make my life a lot easier when you actually do come to me for the round to make sure that you know what you're signing up to and that we haven't got any sort of unexploded landmines in here.
Yeah.
So that's my little 2 cents worth on term sheet. They are negotiable as well. So if there's something in there that you don't like or you disagree with, you can negotiate it with your investor. It's only locked in once you sign.
Yeah, okay. Oh, but also just if you have any questions, please feel free to drop them in the chat. And after we've covered the majority of the content, we'll go into some question time, okay? Thank you.
Cool. So this is a little bit more of a deep dive on some of the terms that you're likely to see in a term sheet. I based this on a priced round because that's sort of the most easy to get your head around. But you can see some of these in safe term sheets as well.
Sure.
But essentially it falls into 4 buckets, right? So you've got your economic terms, i.e., this is what we discussed before. What's this company worth? What's the valuation? How much is being invested? And what is the investor investing in?
Sure.
It'll also usually include a summary cap table at the back of the document just to make sure that everyone really understands how this plays out. Number 2 is the governance. So this is things like who's going to sit on the board, who can make what decisions, future capital raising. So what happens when a company goes back out to market and needs to raise the next round?
Yeah.
Do existing investors have a right to put their money in again? Usually the answer is yes. What happens if it's a down round? And usually there's some anti-dilution protection around that. And then liquidity. So what happens when it's time to sell the business? Or we want to list on NASDAQ or ASX?
Yeah.
Who can make that decision? Does it require every single investor to be in favour, or can the majority of people make that decision? What is the majority? Is it 70% of people voting in favour get to carry it? Is it 80%? Is it the founders plus the lead investor? This is all somewhat negotiated at each round, and it does change as you grow. So in the early days, it might be, 70% a good number, and you run the number, you do the maths, and you go, yep, 2 founders plus 1 lead investor, we can achieve 70%.
Yeah.
That's great. As it goes on, certain investors have different interests, right? So your seed investor might be sitting on a really nice return, but your Series B investor hasn't quite hit their expectations yet. So they have different expectations on what is a good exit. And so it changes, and you've got to navigate it every time.
Yeah. Like, do you see that, like, obviously every single business has like a different model and how they work and things like that, but are there like certain, I guess, like standard templated sort of terms and like and things that sort of that you see sort of like pop up more than not?
100%. Yeah. So I think all of the terms that I've sort of flagged on this slide will crop up on every deal pretty much, which is the priced round. So there is very much standard practice in the industry around these things.
Okay. Yeah.
Cool. And then from signing the term sheet to closing the deal, it can feel like a lifetime. It can feel like a minute. It depends on the round. There is a lot of milestones. I put them up here. But generally what you should expect is an element of due diligence from the investors alongside negotiation of the long-form legal transaction documents. If you are raising for the very first time and you're a brand new business, there's usually not a lot to do. And that's great. There will be quite a simple process.
Right.
If you've been operating for a while and you've got complex arrangements, it gets more complicated. It can be a longer process. So generally that's a bit fit for what stage you are at. In terms of the legal long forms, so 3 key documents. The Constitution, that is very standard. I would say there's sort of 2 parts to it. There's the rules and then there's a schedule. And the rules is pretty much always the same. And the schedule changes a little bit. So the key thing to know about a constitution is that it's got preference share terms in it. So an investor will seek what they call preference shares. What is a preference share? It's like an ordinary share, only a bit funky. So the jargon that we see a lot is 1 times non-participating liquidation preference. And that's definitely considered the industry standard.
Okay.
And this is the bit where you say, what the hell does that mean?
No, yeah, exactly. Yeah, I was just thinking that.
So what that means is your investor has a right to get their money back first.
Oh, okay.
That's really all it means.
Like before anything else happens? Like before the other money
before the other shareholders. So the way that it works, on an exit, say you sell the company, the investor gets the money that they've invested back before ordinary shareholders, founders, employees get anything.
Okay.
But all the investor gets is the amount that they have invested.
Right.
And so say I invest $50,000 into your company, that's my entitlement, $50,000 back. That's all it is.
Yeah.
If this thing goes to the moon, I don't want 50,000 back. I want to participate on the same basis as everyone else. And so in that situation, I can convert my share into an ordinary share, and then I just rank alongside everyone else. Oh, okay. Okay, and so if my entitlement is going to be bigger, that's what I will do.
It feels like pretty safe for the...
And I mean, the idea is that it's an anti-embarrassment kind of clause for the investor. Right. Because they're coming in at a minority, usually each round, most companies will give away around 20% of the equity. Yeah. So the investor is not in a controlling position here. Typically, the founders could have the rights to sell the company tomorrow. Yeah. And so say I invest in your company, right? I invest $50,000. Tomorrow you probably could sell it for $60,000. Right. Right? And I look like a bit of an idiot because if I didn't talk about valuation, but say I've got 10% of that company. Sure. I don't want $6,000 back. Yeah. No, I want my $50,000 back. Right? And so that's the logic behind it. For founders, I would say if you stick to 1 times non-participating, it's pretty standard. Yeah. many investors will require preference shares in order to invest, and you don't have to be afraid of it. It gets a bit funkier later on when you're looking at people doing slightly more nuanced structures, like 2 times or 1.5 times. That is where things get a little bit more complicated. But if you're sticking to a standard 1 times non-participating liquidation preference, you don't have to worry.
Yeah,
it's
okay.
There's a very well-trodden path about that. So that's in your constitution, and then the rest of the document's very standard. Subscription agreement's pretty straightforward too. So that's the document where I say, I'm investing $50,000 in your company. You're going to give me 10 shares. And there's also in there a series of what we call warranties. Those are statements about the condition of the business that I'm going to rely on when I'm investing. So you say to me, we have signed a lease on this awesome premises at CDH. And so I go, okay, great. They're going to have somewhere that they can work from. And you might say to me, I've assigned all of the IP in this product is assigned to the company. The company owns the IP in its product.
Yeah.
I, Darren, don't personally own that IP. I'm going to rely on that statement because when this company blows up and the IP is worth, a lot, I want to know that the company that I own a part of owns that IP. You don't personally own that anymore.
Okay.
So if you were to leave the company for some reason, the company can still take that IP and keep working with it. And, my investment is protected. If those statements turn out, and then there's heaps of statements. One might be, we're not getting sued by anyone right now. All of our employees are, getting paid every month, and we've paid super, and all of these things that we're in compliance with what the laws are.
Yeah.
If one of those statements turned out to be incorrect, then I could make a claim against you. It would need me to have lost money as a result of that, or my investment be impacted. It's very rare to see these, but the one point I would make for founders to be aware of is that when we're on the company side, we would always say that the company is the one that should give the warranties so that founders are not themselves personally liable for these statements.
Yeah.
Now, some investors will try to negotiate that and they will like to see founders stand behind the warranties. That's one that I think is a flag to really get advice on. Sometimes it's appropriate and it's okay for founders to accept that, but that's something that I would definitely be getting legal advice and make sure you understand what the liability position is because this could be significant.
Yeah.
It could be a significant amount of money. You could be jeopardising, your house or your family's financial situation. So definitely get some advice on that if investors are asking for it.
Yeah. Okay.
And then now that I've scared everyone, the shareholders deed is the document that you'll keep in the bottom drawer and pull it out every now and then when stuff happens in the business to work out what are the rules.
Right.
So this is the doc that will live and breathe alongside the company as it grows, and it typically covers stuff like who sits on the board, what information do I have to deliver to my investors each year, quarter, etc. Pro rata rights. So these are the rights for investors to invest again if you go and do another round, right?
Okay.
So if I've invested and I've taken a stake of 10% in your company, can I maintain that position by putting in more in future rounds?
Yeah.
Generally, the rule is yes, investors can keep putting in more and they should expect to have pro rata rights. You sometimes see that be limited to large investors. Again, depends on a case-by-case basis.
Yeah.
And then what we call veto rights or negative controls. So these are the big ticket items that the company should go out to its shareholders and ask for permission before it does.
Right.
So normally they're things that are really outside of the ordinary course of business, right? So hiring and firing the CEO might be one of them.
Okay. So really influential decisions.
Making a massive acquisition might be one of them. Taking on debt financing might be one of them. Really unusual and significant transactions that really change the shape of the business.
Yeah.
What those controls look like, it doesn't necessarily mean you have to go out and get approval from every shareholder. Maybe you need approval from your major investor, or maybe you need just 70% of shareholders. Again, it depends. It also might be that these controls could sit at the board level. And that's often what we would recommend, especially for early stage companies, because it's much easier to move in a really agile way if you have an investor who's represented on your board that can look after the investor's interests. You might say, yep, it requires a board approval that is approved by both the investor director and the founder director. That way we know that the two different camps are both happy with this proposal that we're wanting to put up.
Yeah.
Exit rights we sort of talked about before, who can sell the company and when. And then founder vesting and founder leaver clauses, always a bit of a controversial topic, but it is something to think about.
Like if a co-founder wants to opt out of the business?
Yeah, absolutely.
Yeah.
So a typical founder vesting profile is 4-year vest with a 1-year cliff, same as what you see for employees. When that founder vesting period starts is always an interesting conversation. Is it from incorporation? Sometimes on a major investment, the investor will ask you to reset the founder vesting. So maybe on your Series A, you might need to reset your founder vesting.
Yeah.
And that just really reflects the fact that if the founder were to leave, the company would really be in a really challenging spot. You would probably have to go out and get a professional CEO.
Yeah.
And pay them a really significant equity package to go alongside that. And you know, if there's co-founders, the co-founders are taking on a lot more of the responsibility. So it's really, the concept is that founders need to earn their equity over time by sticking around in the business and being there to build it. It's always controversial. Founders hate it. We normally find that there's a lot of nuance in the way this is ultimately treated. For example, maybe a founder will say, okay, 50% of my shares can be subject to vesting, but 50% need to be treated as already earned. Or, you know, later stage, you might say, well, we started vesting with our Series seed round. I don't want to reset vesting now at Series A. It's not appropriate. Maybe your investor will accept that, maybe they won't. Depends on a case-by-case basis. But all of these things can be negotiated and can be dealt with in a nuanced way. And then founder lock-up and secondary sales is another good one. So, you know, founders might be aware that you can sell shares in your company and make money on that.
Sure.
You don't just have to wait until a big bang exit. You can sell shares along the way. And often, especially with sort of a Series A and beyond, a big portion of the equity will be new capital coming into the company, but sometimes a small part of it is the founders selling down, pay down their mortgage or, you know, just have some cash to live on.
Yeah.
It's really common to see that more and more these days. There's a sort of a delicate balancing act because investors will want to see that the founders are still incentivised to keep working hard in the company.
Yeah.
But sometimes a little bit of capital in your pocket will actually incentivise you more because say if your mortgage is paid off, you're not playing defensively anymore, you can swing for the fences. And so, again, it's always negotiable, it's a case-by-case basis, but that's one to be aware of and at least have a view. If you want to sell down or you think you're going to want to sell down, just be aware of that because there will be clauses in your shareholders agreement that might allow it or might prevent you from doing that.
Yeah, like typically, where would these founders sort of sell their shares to?
To other investors.
Other investors, other co-founders perhaps?
Maybe.
Yeah, okay. But generally investors?
Mostly to investors, yeah.
Okay.
So, for example, say you're doing a Series A and you had a VC fund leading the round and then you maybe had 2 more investors coming in. They might say, yep, okay, 90% of our capital is going to go in and we're going to get new shares, but 10% will go to the founders and we'll buy a little bit of the founders' equity.
Right, okay. Yeah. Because, like, I think, I've learned through hosting many a VC deck breakdown with Hugh Stevens that, oftentimes co-founder breakups and splits can become...
Complicated.
Like the messy,
complicated.
That's the messy part, right?
Yeah,
and it kind of feels like a bit like a prenup sort of vibe, right?
Yeah.
You got to plan for the worst.
That is
outcome.
Such a good. It's I think honestly, co-founder breakups is very similar to marriage breakup.
Yeah.
Potentially more stressful depending on your co-founder, but and your partner, but ultimately it's really messy, and there's no normal, straightforward way of doing it. But if you have your founder vesting right, it can work It can make things a little bit easier because you can start with a presumption, right? So is the presumption going to be, say we're co-founders, is the presumption that if I leave, and I lose my shares, who should get them, right? Do you get them? Do they just sort of go back into the company to be reallocated through the ESOP?
Yeah.
Or to a professional CEO, for example? Or do they get cancelled and then everyone sort of benefits, including investors?
Yeah, okay.
Because they've all got now a slightly bigger slice of the pie because the bit that I owned now doesn't exist. So there's different ways to do it and there's different ways that are right, and what is right for you will depend on what the circumstances are.
Yeah, okay.
So
is it typically like very clearly laid out, like early on?
Yeah, it will be. There'll be a founder vesting clause.
Okay.
And it will say this is what happens if a founder leaves, they give up their shares. And then it will say what happens to the shares that they give up.
Right.
Are they cancelled? Are they held in the pool? Usually, the way that we draft a shareholders deed is that there's actually quite a lot of flexibility, and it's for the board at the time to make the decision that it thinks is in the best interest of the company. So that might mean increasing the portion that is held by the co-founder because they're going to be now stepping into a much bigger role within the company, or it might be that, you've got to make a hire and give the equity to them. So, yes, a little bit of advice and thoughtfulness at the start can hopefully help if things go a little bit off track later on.
It seems like the theme of just most legal things, just like if you set
it up right and it will hopefully work out.
Yeah.
And then this is sort of, I think this might be my last slide, but because I've been talking for a while.
Yes.
But cap table management is crucial. So being mindful, and I know it's so hard at the start to know how much capital you're going to raise, what is the journey of this company, when are we going to pivot, but there are a few rules and restrictions that you need to think about. Number one, under the law in Australia, if you're going to be a proprietary company, you can only have 50 shareholders. And so if you go and issue 30 safes in your pre-seed round, like boom, there's 30 spots gone, plus 2 co-founders, 32 spots gone.
Yeah.
So that does somewhat limit your flexibility. There's things that we can put in place to help reduce that number, but be mindful of it, because if you trip over that 50 limit, it can have pretty bad consequences for you. You can tip into the takeover laws, you can be forced to become a public company, and it just has unintended consequences, more legal and compliance that you don't need to deal with. I would also say be thoughtful about the angels that you take investment from.
Yeah.
Angels are amazing and they serve a really important part of the ecosystem, a really important role in the ecosystem, I should say. However, you want to make sure that they're engaged with the company and that you stay engaged with them, because when you go to do your Series A, your Series B, what have you, you will need them to sign documents.
Yeah.
You're going to need them to sign off on things along the way. And so if you fall out of contact, that can be really hard. So making sure you take money from people that you think are going to stick around, be a part of the journey, and at least be able to contact easily is key. And hopefully they'll be people who call you back, because sometimes it's the day before closing and founders realise, I'm going to need a signature from them. Okay, quickly get on the phone. Are they going to be available? And are they going to be responsive? So, thinking about that, I think, is really good at the start as well. And then, your cap tables are only going to get more complicated the more you raise. The different people that come in, if you do have a co-founder breakup and you readjust between them, and then you've got your ESOP as well, there's a lot going on. And so good hygiene is really important. Get a good system in place and make sure you keep everything recorded. Yeah.
And we've actually run a workshop with the folks over at Carter before.
Yeah, great.
They do have a excellent free tool. I think if you're under a certain amount of finances, you're able to use that tool for free to track your cap table and everything like that. So that's a really powerful tool to be able to use. Cool.
And I've got a discount code for Carter if anyone wants it.
Okay, cool. Yeah, maybe we can spread it to the people in this workshop. All right, will this be your last slide?
Yeah. So this is just a shameless promotion, basically. We've done lots of deals. There are some awesome companies that we've been privileged to work with. And so I think the benefit of that is that we've seen it all before.
Yeah.
I think things keep changing and the space keeps innovating, but we've certainly seen plenty of different issues come up along the way. So hopefully we can help you if you need it.
Awesome. Okay. Let's head over to some questions now. Oh. Okay, cool. Now it's just us. Okay.
Okay.
Great.
I'm going to have some water.
Yes, please, go ahead. Talking a while. Okay, cool. So we had a first question from John.
Mm-hmm.
What happens to safe holders if we decide to close down and cease operations?
Yeah, so the safe will become repayable if you enter into insolvency. Essentially, it sort of becomes a bit like a debt. It's not, I think, for accounting purposes, it's not strictly a debt instrument, but it will become like a debt.
Oh, cool.
Yeah, that's correct. Yeah.
Nice.
So John had said this is what happens before they become shareholders.
Yeah. What rights to safe holders in terms of how funding is provided and spent towards achievement of goals? Do you have to agree on milestones and objectives like upfront?
It really depends. Usually, no. Usually the company will say, what is our plan? And it's usually to fund working capital, right? So to hire people, put into sales, keep working on your product. And generally the company's got a lot of discretion as to how it spends that money. You'll, as part of going out to market, you'll have a business plan and you'll say, this is what we're trying to raise $2 million because we want to hire XYZ, we want to hire 2 salespeople and we want to enter into the New Zealand market and we're going to hire someone over there and we're going to sign a lease. But you're not strictly bound by that. People understand that companies have got to pivot. So there might be some restrictions on how you use it, but generally you're allowed to use it for kind of whatever you want, so long as it's funding the growth and working capital of the business. There might be something like you can't use it to repay debt or you can't use it to pay the founders a dividend, but otherwise so long as it's for the growth of the business, it's usually pretty flexible.
Sure. Great. What happens when future rounds are priced at a lower valuation?
Yeah, down rounds.
Than previous rounds, right? Like what actually happens in that case?
Yeah, great question. Yeah. And something that I didn't talk about, which I probably should have.
No, good.
So remember how I said that preference shares are a bit funky?
Yes.
So they've got the preference, but they've also got what we call an anti-dilution. And what that means, it means that if you do have a down round, so you raise your Series B at a lower valuation than your Series A, the preference shares will have this anti-dilution clause that allows them to be slightly adjusted to factor in the additional dilution that they're getting as a result of the down round.
Right.
So it's a very complicated calculation. But generally, another bit of jargon for you, what we see as the standard is a broad-based weighted average anti-dilution. That is a very complicated formula that I'm not going to talk about in detail, but essentially it accounts for how deep the discount is and how big the discounted round is. So if you're raising just a small round at a small discount, there's the true-up is a smaller amount. If you're raising a massive round at a massive discount, the true-up will be bigger. And it's to accommodate some type of parity, essentially, between different investors.
Great. Let me just try to get to some other questions. So Billy just asked, when discussing the term sheet, what are 3 critical things to understand?
I think you've got to be aligned on valuation. That's key, right? So what's the investor putting in? What valuation are they putting it in at? And how does the ESOP work? So usually there will be an allocation for ESOP built into that. It's usually around 10%, depends on the situation. And the key thing about the ESOP that is interesting and complicated is that the ESOP will not dilute the incoming investor. It dilutes the existing holders. So when you up your ESOP, as a founder, you're the one being diluted, not your incoming investor. And so that's one thing that's important to understand, and that's why we say you should put the cap table on the back cover of the term sheet so that everyone is clear on how the maths work and that you don't get into a fight about that later.
Right.
So that's one. Number 2 is governance, right? So as the founder, what am I going to be able to just do in the business, and when do I need to go to talk to my investors and get their approval for things? And does that align with what I want? Like, do I want to be doing a board meeting every month, and do I need to do formal papers for it? Or is it more like we do a board meeting once a quarter, and in the meantime I send an email to my investors, I don't need to get their approval for anything, and I can just go and do it?
Yeah.
Usually it's probably something, the truth and the most common is that it'll be somewhere in between those two things.
Yeah. Because obviously you want to maintain your own level of freedom and autonomy to do what you need to do, but I guess the investor also needs to...
Yeah, and they need to... And, you've got to remember that your investors have got their own investors that they've got to report to, right?
So true.
The VC fund managers have also got LPs that they've got to report to, and they've got to show that they're being prudent about the way they're supervising their investments. And so it's sort of your job to help them with that, right? And so it's about striking what is the right balance so that they can have a lot of confidence in you and your ability to just make the right call and run the business, whilst also, making sure that their own interests and their investors are protected.
Yeah. Okay. Let me skip over... You highlight this one. What's the typical percentage for the ESOP pool that you've seen?
Around 10%.
Okay.
I would say, especially in the early stage.
Right.
Yeah.
Okay. So then it just depends on, I don't know too much about ESOPs, but from what I've heard, sometimes it's much like the, I forgot the term you used before, but I guess as you work longer in the company, your shares sort
the
of...
vesting?
Yeah.
Yeah.
The shares sort of grow, like based on how much time you spent with the company, right?
Absolutely, yeah. So there's two things to think about. So one is, what is the ESOP pool? And in the early stages, something around 10% is normal. Might be a little bit lower than that, actually, 8% or so. And what your investors will want to see is they want to see that ESOP pool be pretty fulsome, because they want to see that your employees are really incentivised. They want to see you making grants. They want to make sure that their employees are excited about the business. They're going to stick around. And they're going to work really hard and grow and drive the growth of the business, right? So the pool is the total amount of equity that you're setting aside to give to employees, all employees.
Right.
And so you don't have to give equity to every employee, but the pool is the total that's available. Then you've got individual grants that go to different people. So say I'm the founder and you're the employee. Darren, I've got a pool of 10%, but you're a superstar, so I'm going to give you a grant. You can have 4% of that because you're a superstar, right? I would never encourage people to actually promise percentages because I think everyone knows about the Facebook story.
I was just going to bring that up.
Don't promise percentages. Promise I'm going to give you 5 shares or whatever. But I'm just illustrating.
Sure.
Illustrating.
Yeah.
So
it comes up a lot in these discussions.
Yeah, and so the typical structure of an ESOP, the government changed a bunch of stuff in the budget last night. This may not be the way forever, but at the moment, the typical structure is that you have a 4-year vesting period with a 1-year cliff. So that means that employees need to stick with the business for 4 years to fully earn their options. They get if they leave in the first year, they get nothing. If they leave somewhere between years 2 and 4, they get a pro rata proportion of that. So nothing vests until the end of year 1, and then it'll vest either quarterly or monthly after that.
Yeah.
Usually it's options, structured as an option. That is a right to buy a share or to have a share issued to you. There is currently this program called the Startup Tax Concessions that apply to early stage companies and have historically been really good. Most startup companies will use that structure of ESOP plan. Again, tax law is going to change, and so we'll watch this space for where it lands. Yeah.
And I guess that's why you need to stay in touch with the updates and have legal advisory, right?
Yes, 100%. It is moving pretty fast.
Yeah. I'm just going to show this on screen. So Billy asks, how much does it typically cost for founders to create a shareholders deed, subscription agreement, and constitution?
Oh, it's a great question.
The legal sort of overhead.
I think there's a number of different factors that drive the cost, right? So The biggest one is the amount of negotiation and back and forth. So what drives that? It is not having a clear agreement in your term sheet with your investor about what the terms are, and then having like multiple investors. So typically the cost will go up each round as you're starting to deal with interplay between new investors coming in, old investors that are already there, and there can be a little bit of, oh, I want what he's having sort of thing. If you're going to give your new investor these rights, I want them too. And so you can end up in sort of like a three-way negotiation, which is not ideal. So ballpark for a first round, I know you're going to commit me to give a quote, but it depends a little bit,
Sure.
How many founders have you got?
Yeah.
What are the terms? But if we're doing something really simple for a seed round, it could be sort of, around 20 to 30,000, I think, starting from there.
Sure. Yeah. Sure. And like obviously it's just dependent on how much time the legal staff are spending on the actual
That's right.
thing,
And what drives that is how quickly do the founders and the investors get to agreement, right? Are you going back and forth? Are you changing things? Is there a lot of rework required? If it's pretty simple and everyone's on the same page, hopefully it should be quite a simple process.
Yeah.
It can be really fast as well.
And like, who pays for these fees?
Oh, this is a really good point. So on most deals, there's two sets of lawyers, right? There's the company's lawyers, i.e. the founder's lawyers, and there is the investor's lawyers. And in the term sheet, investors will usually ask the company to pay their legal costs up to a cap.
Wow.
And so the answer is the company's paying for both sets of lawyers.
Yeah.
Actually.
Okay. Wow, good to know.
But it should be up to a cap.
Sure.
Yeah.
Yeah. So, could you comment on the deal flow climate at the moment and the risk appetite of investors?
Interesting. So, look, I don't think I'm the first person to say it is a little bit of a two-speed economy out there.
Yeah,
if you are in AI and you're building an AI native business, the world is your oyster. You may not even need a lot of capital, actually.
Yeah,
And that's one of the interesting developments is that the area that investors want to fund is not necessarily needing investment because of the beauty of Claude and other platforms to build on. But I've just knocked the table.
You're good.
But no, we are seeing that early stage deal flow is still quite steady. There's always lots of entrepreneurs coming through with lots of businesses, and early stage deal flow is usually somewhat immune from the fluctuations happening in the broader market and the broader economy because it is just a lot longer until a company needs to exit or list. And so investors sort of look at it quite differently. So yes, early stage stuff is pretty resilient. Obviously, we've seen the SaaS apocalypse happen in public markets, and that obviously, whenever anything major happens in public markets, it does sort of send shockwaves back through the later stages. So, Series C's, B's, what have you. We're seeing that a little bit. And we're also just seeing SaaS companies looking to pivot pretty significantly, and so they're not particularly focused on raising a lot at the moment.
Yeah.
And so most of them are focused on that. So, I think early stage stuff is still holding up pretty strong. M&A activity is still happening, but, it is a bit challenging for SaaS companies at the moment.
Yeah. I think I've seen that firsthand paying attention to the ecosystem as well.
Yeah.
And especially, I think it leads on pretty naturally to these last two questions, which is...
The only thing I'd say, though, is that we are also seeing, AI is changing the game on so many things.
Yeah.
We're seeing, bigger rounds than we've ever seen. We're seeing bigger exits than we've ever seen. The Cursor sale is the biggest private deal that has ever happened. So...
Lovable, fastest growing company ever.
It's easy to be, we're both customers of the so I think, it is easy to be all doom and gloom, but there is actually still a lot of exciting activity happening. It's just congregating in certain places in a really major way.
Yeah. I think let's go with Ali's question first. If a company is making money and bootstrapped, What's the pros and cons of actually raising? Do they need to raise?
That's a great question. And I think it depends on your growth. I mean, it depends on what you want to achieve. So taking investment comes with not just capital. It comes with a partner, and different investors will tell you different things, and other founders will tell you different things about which investors are truly there on the journey for you and which are really just investing their money. So have a think about it. Have a think about what you might want that is more than just capital. Sure, a bit of capital might help you supercharge your growth, but could you bring on a strategic partner that might give you some guidance, might sit on your board? Is there an angel investor that you admire, maybe an exited founder who you think could give you some good mentoring as well as the investment? That could be a good combination. More and more we're seeing people who've got quite a public profile, like celebrities or professional athletes, enter into investing. And so
because they bring their brand with them.
Is there can you associate your brand with someone? Are they up for that? Maybe they're not up for that. So there's lots of things that an investor can bring beyond just money. And so thinking about that and what your goals are could sort of change your mind a little bit. It doesn't have to just be a classic VC fund. You could look at other people out there. Yeah. Wow.
And just finally, our very last question. Do you have some advice for when to look to raise capital for the first time versus continue to bootstrap?
Oh, it's a great question. I think it's quite similar to what I just said, right? Which is... I
guess the question is more like when do you look to raise capital?
Yeah, so I think there's two parts to that. One is in your journey and one is in the year as well. So be mindful that in Australia, things do close down over the summer. There's definitely a window, and that window is sort of now, I reckon. Looking at, if you're looking to raise, I think now is a really good time of year to do it because you've got a lot of people around, a lot of activity happening. You might have some good performance data about your business already from how the year's starting. Always trying to raise at a bit of an inflection point is good. You want to show really good performance.
Yeah.
And great opportunity ahead to get investors excited. It always takes way longer than you think. Way longer. So you don't want to be running right up into sort of November, December time and trying to get checks in the door. So starting early is a really good thing. But I think this question is actually about how long do you bootstrap for and then when do you take on investment. I think it depends on how big you want to be. You'll know the right time, but if you think you're going to want to raise soon, probably start now because it will take longer.
Yeah. Because obviously the thinking behind why you want investment is always so you can have more capital to grow even more, right? And then it won't really matter that your shares are diluted or it's not as much as it used to be because now it's worth that much more, right?
Smaller slice of a bigger pie is the concept.
Yeah.
It can also be really galvanizing for your employees when you announce a big round. I'm not saying that you should do it for that reason, but it can that can be something that gets a bit of momentum. There's lots of upsides to it beyond just the pure cash.
Yeah. All right. Well, that's all the time we have, everyone. Yes. And for those asking, the recording, we'll record it and post it up on YouTube. Also trying our hand on some shorts, so please feel free to pay attention to those.
There's one more question. I don't know if you want to... Oh, I just seen this one about can you explain the valve cap on a safe?
Oh, sure.
Sure, I'll do this very quickly. Essentially, so I didn't talk about this because I was trying to keep it simple, but if you have a safe and then you don't end up raising the next round, or you raise but the company's just absolutely taken off, it's not necessarily fair to go with the discount model. And so the val cap is there essentially as a backup. And you don't have to have it, by the way, but it's there to say, we agree between us. We're not agreeing a valuation, but it's definitely less than 10 million, right?
Yeah.
And so if you take off and your next round is at 30 million valuation, I'm going to convert at the 10 million price.
Right, okay.
Yeah, so that's the simple concept of the val cap.
Cool. Okay. All right. That's all the questions that we have today. But yes, it will be available up on YouTube. Big thank you for Claire for coming in today and giving us a great breakdown on the legalities behind how to actually navigate a raise. If you are interested in more content from Cremona Digital Hub, we have another workshop in 2 weeks' time, back with another favourite VC deck breakdown with Hugh Stevens. If you'd like to submit your deck to be considered to be broken down, you can find the link on the event page. But otherwise, stay tuned for another month of really good lunch and learns. We've got some really exciting workshops that we're cooking up for June. Okay. Thank you very much, everyone.
Thanks,
Bye-bye.
everyone.